Some new research and some new speculation that the tried and true 4% rule for sustainable withdrawals in retirement no longer works. I've got that update and some solutions coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. All right, so are you relying on the 4% rule to solve your retirement income and making sure that you don't draw down your assets too quickly? If so, I've always said you need a 5-factor retirement plan instead or in tandem with that 4% rule. But I've also been very watchful. All of our CFPs over here at Korhorn Financial Group have been very watchful and hesitant about this particular economic and financial climate and what that's going to do to the 4% rule. Therefore, no surprise to us that Morningstar recently redid the analysis and said, guys, it might not work anymore. The 4% rule, which by the way, the founder and some other analysts came out and said, you know what, it's really a 5% rule. No, that defies logic. That defies logic and doesn't apply today. Morningstar came out with an update. You're gonna find the link below. But they're saying 4% doesn't go up to 5%. We can't even actually have a sustainable withdrawal rate at 4% and needs to be less. So the 4% rule was originally developed in the early 1990s by a financial professional, and who basically went out and studied a whole bunch of trials of rolling 30-year time periods and looked at a normal mix of stocks and bonds, a conservative mix of stocks and bonds, equally balanced, okay, and said, okay, of all of these different real time periods, what's a sustainable withdrawal rate that someone could pull out of their dollars and not run out of money for at least 30 years, okay? And all of that analysis, all that real data and those 30-year rolling time periods said you can draw out 4% of your retirement nest egg every single year and then adjust that for inflation. So increase that for inflation each year so that your income keeps up with inflation. That's what he found out. Some recent analysis over the past 10 years, different financial professionals have collaborated, redone this math, the study. It hasn't changed much, however, because of the way stocks have performed over the past 10 years or so. Over the couple years ago, they said, well, you could actually withdraw 5% or more. To me, that defied logic for two reasons. Number one, interest rates are now as low as they can possibly go, and it's going to be hard for those interest rates to go up into the future. Therefore, how can you, in a 50-50 split between stocks and bonds, if half of your money is now producing a fraction of the return that it used to return, how can that 4% withdrawal rate still stand that test? I don't think it can, okay? And number two, stock valuations are significantly higher right now. The multiples are significantly higher and well above average. And so if you look at that, you would say, well, over long periods of time, the typical multiple that investors pay for stocks is this. And it oscillates, high and low. And right now, we're paying very high multiples compared to that long-term average. And therefore, not to get too geeky, but you could say we've collected some of the future returns. We've already collected them and seen them today. Therefore, just based on historical perspective, future returns likely will be below average compared to what we've seen recently. When you combine low interest rates and high valuations, therefore potentially lower equity returns in the future, it's hard to believe that the 4% rule is still sustainable. Time will tell. We'll see how this ages. Morningstar redid their analysis, or did the analysis, and they've come up with a 3.3% withdrawal rule. That's That's the new 4% is 3.3%. That's their recommendation. Now, they also say, listen, if you do withdraw 4% or that's what you've been on, it doesn't mean you're for sure, it's not sustainable, you're going to run out of money. They just say within their trials, about a 75% confidence rate that you won't run out of money, meaning 25% of the time you'd need to adjust your spending level or run the risk of running out of money at some point in retirement. So based on Morningstar's recent analysis, that 4% rule is now a 3.3% withdrawal rule. All right, so do you agree with this, or do you say, no, I've been listening, I've heard the 4% withdrawal rule for 30 years, that's what I'm sticking with? Guys, I would be aware of it. Well, I'll just tell you, anytime I'm doing retirement planning for folks, I'm first doing a 5-factor retirement plan. I'm going to get to that in a second, and you know that's going to be what I recommend. Okay, and then you got to make sure through that 5-factor retirement plan that your overall plan works, okay? And I'll get more into that in just a second. But after that, then once we say, yes, it works, we then need to sharpen the pencil and figure out, okay, exactly where are we going to draw income from and how much income are we going to draw? And I always look at 3% and 4%, and I give folks that range, okay? Number one, that's what I do. So if you look at this recent research by Morningstar and say 3.3%, okay, I guess that's me. What are some other alternatives? I mean, number one, I would tell you, I mean, you could just say 3%. Just to make things simple. I'm going to withdraw 3% instead of 4%. So that's the first thing you could do, or 3.3%. That's the first option that you could consider. Second is another one that here at Korhorn Financial Group we do a lot, and that is most people, at least up until right now, this inflationary time period, most people don't need an increase in their withdrawals every single year. Typically, you set a sustainable withdrawal rate, a comfortable withdrawal rate, and most people use that for 1, 2, 3 years. They don't need that inflation adjustment each and every year. So you could choose, now I'm going to continue to draw 4% out, but I'm not going to increase that amount by inflation every single year. That's the second option. And third option, I mean, another big flaw within the 4% rule is it just assumes no matter what happens in the economy, you're just going to continue to withdraw that same amount, continue to expend the same amount. Well, another alternative that you could consider if you still want to stick to the 4% rule is, listen, if there's a big market drop, if there's a big drop in my portfolio, I'm going to reduce what I'm drawing out. If there's a 30% drop in the stock market or 20% drop in my portfolio, I'll reduce my withdrawals by 5%, something like that. The original 4% rule, and then really all of the analysis that has come afterwards, just assumes you set your withdrawal rate at 4% of your nest egg the day you retire, and then you just simply inflate that amount with inflation every single year, and you just, you continue to do that with your head in the sand. You don't adjust anything. Well, you could just decide up front, create a rule, as some financial professionals say, create a rule that says, well, if my portfolio drops, my income drops as well. I would take all of this with a grain of sand. I just would. It's just, to me, you've got to do a 5-factor retirement plan to see what is sustainable for your situation. You have to. And then a 3% rule, 4% rule, creating some rules or guidelines around that is all good, but it's got to start with a 5-factor retirement plan. You've got to figure out, okay, what age am I going to retire? And what's my life expectancy? So that's age. That's the first factor. Second, how much do I need to spend? What's my lifestyle? And then I just did a video on that. That one is bottom up, as opposed to while you're working, your income is top down, where you look at a gross number and then chip away with taxes, health insurance, and so on. Within retirement, you look at that spending number. What do I need for my base expenses? And then I add on health insurance, and I add on extra vacation allowance, and I add on a new car every few years, and I add on taxes, right? So you've got to start with that, and then you add inflation as well. So that's the second factor. Third factor is, what are my income sources in retirement? Will I have part-time income? Will I be able to optimize my Social Security? Do I have rental income coming in? So looking at that. Fourth area is, what is your nest egg? How much have you saved up? How much will you continue to be saving up between now and retirement? And then the fifth factor is, how much investment risk are you willing to take? Are you comfortable taking a lot of risk in retirement? Do you want to take no risk in retirement, or be like everyone else? And again, this 4% analysis assumes about 50-50. You've got to start with that 5-factor retirement plan, because if any one of those choices seems more important to you than the others, then it's going to limit your options in the other areas, right? These 5 factors are interdependent. You decide, I've got to be done at 62. Well, that's going to determine how much you can spend, or what your income sources need to be, or really how much you need to be saving, okay, or how much risk you need to take in your investments. So just looking and saying, well, I've saved what I saved, I'll draw 4% off of that, is not going to cut it for retirement. You've got to start with that 5-factor retirement plan. And then after that, within that, that will tell you, here's a sustainable amount that you can withdraw from your investments. And then you've got to work with your CFP to figure out exactly how you do that, whether you adjust for inflation every year, which accounts those come from, how you adjust for taxes, that sort of thing. Okay, so that's the detailed analysis. Ultimately, I don't think there's much wrong with a 3 to 4% sort of rule of thumb or guideline. That can get you a lot of the way there. It's just no substitute for financial planning. Guys, my take, we'll see how this ages. I don't think 4% is a sustainable withdrawal rate. I don't. I would lean closer to 3%. We've got, like I said, low interest rates. I expect to be low for a long time. We've got high valuations in stocks, and the couple other that I didn't mention, we're trending higher on inflation. I don't think that will last, but we're currently trending higher, and we've got longevity. And so all of that suggests a 4% rule. I would lean closer to 3%. It's no substitute for planning. Work with your CFP on that. If you don't have a CFP that's helping you with comprehensive financial planning, you can always contact one on my team. Find us online, Korhorn.com. That's Korhorn with a K, wisemoneyshow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.